We've already learned about budgeting, but the process of preparing budgets, then budgets are the benchmarks which are used to measure the actual performance with the budgeted performance and budgets which are given. Then when there are any deviations or variations, measures are taken to um, control those deviations. So on the same note, we have another concept called as standard costing or variance analysis. So variance analysis basically they decide what are the standards for the elements of cost. There are three elements of cost: material, labor, expenses. All of them are again subdivided into direct and indirect cost based on their identifiability. So all direct costs are pooled together and we call that as prime cost, and all um, indirect costs are pooled together and called as overhead cost. So the standard costs are decided for material, standard costs are decided for labor, and all the overheads together, what the standard costs are decided. Um, Now each of these things are compared. Each of these standard costs are used for comparing the actual cost of material, actual cost of labor, actual cost of overhead. They are used for um, compare the standard cost. The basic part of it, elementary understanding about variance analysis was already done in management accounting paper. So the advanced version is considered here. Only the advanced variances are given. What are the advanced variances? We have mixed variance and yield variance, planning and operation, modern environment. But quickly, let's go through understanding about what are the cost variances at the basic level. So let's say if we are talking about the material first variance, what has to be calculated is material cost variance. The cost variance will be basically about the standard cost of material minus the actual cost of material. So standard cost minus actual cost. But then how do we arrive at what is the standard cost? In case of material, it is the number of units into the price. So that is how the first variance, that is the cost variance, which is calculated at actual cost of material. The standard cost is calculated as the standard quantity into the standard price minus the actual quantity to the actual price. So that's the basic first variance, which is the cost variance, which is calculated. Actual quantity into the actual price. Now this is basically a combination of for two. The product of two variables is brought together. That is, one is a quantity and the other one is price. So there are two things. The variance could be, what is variance when the actual cost is not on par with what is the standard cost, when there is a difference. But then why would there be a difference? The difference could be on account of the quantities are not same as what they are planned, or there was a rise in the price. So all these is basic study which is taken up in MA. We are not getting into those intricacies, only to understand what are the variances we have. So this can be further divided into two things, that is the price variance. The variance could be on account of difference in the price, so material price variance. Or going further, we can also look into this one as material, the quantity variance. Quantities were different, therefore quantity variance also could be there. So how do we calculate what is price variance? Price variance is equal to, this is the difference in the prices, that is the standard price and the actual price. Standard price minus the actual price applicable at the total quantity which is actually purchased, actual quantity. So that's the formula here. The quantity variance is the difference between the standard quantity, the actual quantity, the difference between the standard quantity and the actual quantity applicable at the standard price. So what should be the rate of this particular thing, the standard thing, which is considered. Until here, the study was done in management accounting. So now basically the questions would not be till this particular level. But beyond this, the quantity, see, it is not always that whatever is the input which is introduced into the process, the same thing would come out as the output. But there could be a difference in the output. So then we have to check what is the output, so yield variance. Then it's not always that only one type of material is used to produce the product. Multiple types of inputs or components of products can be used. So when there are multiple components, multiple inputs which are used, so how much was decided for the components? Let's say that there are two components, A and B. A and B should be used in the proportion of 60 to 40. So the actual also should happen in the proportion of 60 to 40. If there is anything which is different from that, then that would be a variance. So we see that when the quantities are inputted, these quantities could be in multiple components. So we have this as material mix variance and material yield variance. So this can be divided into mixed variance and yield variance. So we are going to look into these variances, that is material mix variance and material yield variance. What's the output which is generated? So this is the background of what we have. So now moving forward, uh, let's get back to the PPT. So under advanced variances, we are going to discuss about mix and yield variance, planning and operating modern environments. So that's theoretical. So the usage variance is divided into mix variance and yield variance. So what is material mix and yield variance? Only they use materials can be substituted for each other. The material mix or material yield variance, I'll give you the formula. See the difference in the mix, each of these mix, the proportion of the mix. So let's say that standard mix is decided in a particular proportion. Standard quantities, whatever are the proportions which are given, the actual quantities with the proportions which are given. So what are we supposed to do? We have to value them for this particular standard quantity. What is the standard cost of the standard inputs? So A, B, C, the proportion in which these quantities are valued at the standard price. The actual quantities are also valued at the standard price. It's only the mixed part we are finding out the difference. See, we have the standard cost, the standard rate, then we have the standard mix, then the actual mix. We are testing here about what is the variance in the mix which is used. So the difference between these two things, it is nothing else. We are not focusing on anything because it's a mixed variance. The mixed variance will be testing it out at what is the difference between the proportion of material used under standard, the proportion of material which should be used under actual. So when the difference between these two is taken into consideration, this should be applicable at the standard rate. That is the logic there. But it is not just one thing. There are many things which are there. Many components are there. As many number of components are there. So for each of them, take the standard quantity, multiply into standard rate. Actual quantity, multiply into standard rate. So all of them valued at the standard rate. We would get what is the mixed variance. So quickly, we'll go back to the exam kit and then take it up. Few questions from that. So from the examination kit, under mixed pay, under once we get disconnected again, to get back onto the track is so mix and yield variances. Under that, let's select the first question. 181. Let's take it up 181. What is the material yield variance? What is the material mix variance? So we'll take 183 first, then we'll take 181. One 183. The question 183 on the screen. CBC JC Limited mixes three materials to produce a chemical SGR. The following extract from a standard cost card shows the materials to be used in producing 100 kgs of chemical SGR. There are three materials which are used, that is material A, B and C. The quantities given are 50, 40, 20, rates are given and the cost is given. On October 20, during October, 23,180 kgs of SGR were produced using the following materials. What is the total material mix variance? The standards when they are decided, the standards when they are decided, the standards, the following extract from a standard cost card shows the materials to be used to producing 100 kgs. But was the actual production according to 100 kgs of chemical? No. During October, the total quantity, the actual quantity was to the extent of 23,180 kgs of production was taken up. So the quantities which are mentioned, we have it as 50, 40 and 20. Okay. But the actual quantity is the actual quantity of material which is consumed is in a different proportion, in a different quantity. The because the production is different. They have initially decided. Um, I mean, the standards were decided to be at for 100 kgs. So if it is for 100 kgs, then we see the proportions to be as 50, 40 and 20, but the actuals are incurred for the production of 23,180 kgs. So they both are not on par that it can be used for comparison. What are we to do now? Actual anyway is already incurred, so actual will not be altered, but the standards whatever are given, that will be enhanced to the level of actual. So whatever is the actual activity which is taken up, things will be enhanced until that point. So let's prepare the let's first write what is the standard rate. Standard rate is given as $10, then we see it is 5, then we see it is 9. After that, the standard quantities are given. How are these standard quantities given? Standard quantities are given as 50, 40, and 20. But we see the actual quantities are something different. Actual quantities are given at 13,200, then 7,600, then we have 5,600. So they are not on par that we can use them to compare. So the comparison should take place. When the comparison has to take place, we need to enhance this quantity according to this one. So what's the total actual quantity? The total actual quantity we see that to be as 26,400. So that's the total actual quantity, 26,400. Now the standard also should be made on par with 26,400. So the total standard quantity also should become at 26,400. But this 26,400 should be in the proportion of 50 is to 40 is to 20. So we will write it as this is revised standard quantity. Why? Because it has to be on par with the actual quantity. So that's the purpose here. So when it has to be revised according to that, divide this into this proportion. So when the total is how would we divide that? Um, if for 110 it is to 26,400, 50 how much? So 50 into 26,400 divided by 110. Okay. After we do this, basically we are trying to find out the difference in the mix. So the according to the standard mix, it should be only 12,000. But how much was it? It was 13,200. So there is a difference in the mix. So the difference in the mix applied at the standard rate, that is what has to be taken. So let's find out revised standard quantity minus actual quantity. We would not write the negative the difference in these two things have to be taken. Without writing the negative figure, we have to basically mention that, but keep a note of that. Otherwise, let's do one thing. If that is confusing, standard cost of revise the standard mix. So let's take the standard rate into the standard quantity. Then let's find out what is standard cost of actual mix. So multiply that is equal to the standard rate into the actual mix. Now, find out the difference between these two. Now, keep a track of which one. So, the actual cost always should be less than the standard cost. If it is exceeding the standard cost, if the actual cost exceeds the standard cost, then it is adverse. Otherwise, it is favorable. So, let's make a comparison. The standard cost is decided only at 120,000, but the actual cost which is decided is 132,000. So, 132,000 is more than. So the variance, let's find out. Do not write a negative symbol. So just ensure that you are finding out the difference between that these two values. So like that, let's keep writing. But we'll decide what is the whether it is favorable or adverse. See, actual cost, whenever it exceeds the standard cost, it is adverse. When the actual cost is less than the standard cost. Let's say somebody gives you 100 rupees, you spend less than 100 rupees, it is some saving there. It is some favorable kick there. So here also, the according to the standard, the one which is decided is 48, but now they have spent only 38, so 10,000 is favorable. Then comes this one is adverse because it's more than no, did I make a mistake? It is more than, yes, that's right. It is more than that. So this is adverse. So overall, we see that the overall impact is it's adverse of 9,200. So we see adverse of 9,200. So that's how material mix variance is calculated. So let's take up the next question. Question number 184. Mr. Green makes salads. The standard plate of salad has 30 grams of lettuce, 50 grams of pepper, and 80 grams of beetroot. The standard price of three ingredients are given as $0.2 per kg, $0.4 per kg, and zero point 0.8. The actual prices where something is given. Mr. Green has been experimenting, and so in July he changed the mix of vegetables on the plate. Thus, 1500 plates contain 62,000 grams of lettuce, 81,000 grams of pepper, 81,000 grams of pepper, and 102,000 grams of beetroot. What is the cost difference between the actual mix and the standard mix? So when the standards are decided, the standards are given per plate. The standard plate of salad. So one single plate, that's what is given, standard plate. But the actual number of plates which were made were 1,500 plates. So we see that standards and actuals are not matching with each other. What do? We make these standards on par with the actual. So instead of having only just one plate, then we make that to be as 1,500 plates. How many materials, how many types of ingredients are there? three types of material, ingredients or material. Lettuce, then we have peppers, then we have beetroot. The standard mix. Starting with the standard mix. So the standard plate of material, is given as 30 grams, then 50 grams, then 80 grams. So this 30, 50, 80 grams, when we revise them according to the actual mix, but because actual mix is something else, actual mix is given to us as 62,000 grams, then 81,000 grams, then 102,000 grams. So now when we take the total stands at 2,45,000. So the same thing, 2,45,000 has to be uh, taken into consideration. So the same logic about what we have done in the previous situation. This is revised standard mix. Okay. Let's take the standard rate. Standard rates are given as 0.2 per kg, but these are all grams. Whatever which are given here are all grams. The rates are given as per kg. So let's make that into grams. 0.2, it's per kg. In a kg, there are 1,000 grams. No, divided by 1,000 grams. No? So it should be divided by is equal to 0.4 divided by 1,000. Then here it is 0.8 divided by 1,000. Standard cost of revised standard mix, then standard cost of actual mix. Then find out the difference, variance or material mix variance. Let's put it as material mix variance. Find out the difference between these two. Individually, if we check, this is adverse, this is also adverse, but this is favorable. So overall is it is favorable. So that's the answer. This one is the material mixed variance, the total one. So this is the answer. Um, for the same set of data, we are asked to find out what is the yield variance. Mr. Green makes salad. The standard plate of salad has 30 grams of lettuce. The same data set. Everything what we have done just now, it's the same thing, but um, we are asked to find out the yield variance. That's the only thing. The same set of data, whatever we have. So now we need to find out what is the yield variance. So in case of yield variance, what do? We have to find out what is the difference between what is the standard yield, what is the actual yield. That thing has to be compared and apply it at the standard rate. But there are three different standard rates. The first thing is we need to find out what is the weighted average standard rate has to be calculated. So weighted average standard rate is taken and applied for the difference in the yield. So the yield, if we are talking about material yield variance would be what is the standard rate? Standard rate applied for into the difference between the standard yield minus the actual yield. Actual yield we know how many plates did they make? They made 1,500 plates. But what did they initially decide? They initially decided to make one plate with these quantities, that is 30 grams, 50 grams, and 80 grams. So altogether, we see that it is 180 grams of various components of various material are used to make one plate. Okay. So if that is the case, if we use those things, first let's calculate what is this standard rate. There are three different materials. That's the standard rate. But mixed is also given. Mixed is also given to us. Weighted average standard rate. So on an average, we need to find out. So we got the standard rate to be as 0.09. Okay, so there are three variables we need to know. We know what is the standard rate, which is 0.09. We also know what is the actual output, which is 1,500 units. But what is the standard yield, standard output which should be produced? Okay. Um, for one plate, the quantity which is required is 160. The quantity which is required for making one plate is um, total quantity of all the three things is 160, but we have revised the standard mix according to the actual mix. So actual mix, the total quantity has come up to 245,000. Okay, so the details given is see with for one plate, to make one plate, it requires 160 total grams are 160. But then we have revised that. How did we revise that? We have already checked that. So with the revised standard mix, we see that the total consumption is uh, 245,000. How did we do that? We already got that point. The logic part of it is, if to make one plate, the ingredients or the material required is 160, but we have revised it to be as 245,000. So to make 245 by using 245,000 total grams of material, how many plates can be made? So the logic will come out to be as is equal to 1 into 245,000 divided by 160. So we got it as 1,300 and 1,531 plates. The actual yield is, how much is actual yield? This is standard yield. We also know what is the actual yield. Actual yield is already mentioned in the question that they have made 1,500 plates. We just have to substitute that. So material yield variance is equal to the standard rate. Standard rate we calculated, it is 0.09 into the standard yield, actual yield, any order we can write. The standard yield is 1,531.25 minus 1,500 is equal to. See the difference between these two. So we got it as 2,825. Now we have to decide whether it is adverse or favorable. See here, they have decided that the output should be by using 160 grams, one plate can be made. So by using 245,000 grams, 1,531 plates can be made. But did they make 1,531 plates? They made only 1,500 plates. So they made less than what is decided. So this is yield. This is output. Output should always exceed the actual output should exceed the standard output. So they should produce better. They should produce more. So according to the usage of 245,000 grams, they should be making 1,531 plates. But how many did they make? They made only 1,500 plates. So when they made less plates, then that is an adverse scenario. So that is adverse 2000, 2.8125 adverse. Okay, so that's material mix variance and material yield variance. If time permits, we'll take up some more questions, but that's how we look into um, the variance analysis, mix variance and yield variance. Then similarly for sales mix and sales quantity variances also, we work it out. Um, the variance can happen right at the time of planning or at the time of implementation. So if they, at the time of planning, if they fail to plan properly, that is a variance which takes place at the time of planning. But at the time of implementation, if there is a variance arising, that is operational variance. So traditional variances are a combination of the variance happening at the time of planning. They have not planned properly. They have not included the right amount of standards. Standards only were wrongly set. So there is a variance which arises at the time of planning. At the time of implementation, the actuals were not on par with whatever is decided. So uh, that would be an operational variance. So variance can happen both at the time of planning, the variance can arise, or at the time of implementation, a variance can arise. What are the characteristics of modern environment? Um, See, now these accounting um, techniques and all, the conventional techniques we've seen, and then what changes happened in the costing techniques, accounting part of these things. What changes happened over a period of time? What new things have come into picture? We have looked into. So the manufacturing of late is not in the traditional conventional method where there's a lot of dependence on manpower, but then the technology has overtaken the manufacturing scenario. When the technology has overtaken that, so there is a change in the way the work is carried on at the manufacturing level. So we see what are the characteristics of the modern environment, modern manufacturing environment. So there are certain new things which have come up. We will learn about those things. The first characteristic of the modern environment is there is a lot of greater use of advanced manufacturing technology. So technology is replacing, machinery is replacing the manpower. Machineries are replacing the labor hours or man hours. That is a see that will result in greater efficiency. That will result in the speed at which they produce, the output which is produced is much higher or larger in quantity. So there is a shift from one thing to another thing. From the conventional method, now they are moving into advanced manufacturing technology. So now the scenario is much more of a global environment. It is not restricted only to domestic markets, but the products produced are exported to other countries, and various types of input or materials are imported from various countries. A greater focus is on cost reduction. One were the days when they were not very focused on cutting down on the cost. Whatever cost they incurred, that was sold to the customers. These customers didn't have much choice, so whatever was the cost, they would buy that. But then now the competition is severe. There are many foreign players also entering into the domestic market. Many players are present there in the domestic market. So Each one has their own competitive advantage. Someone has worked out on the cost reduction. They have controlled their cost, so they offer their products at a cheaper price. When such is the scenario, then to be on par with the competitor, the businesses have to, they have no other option but to reduce their cost price. When they have to reduce the cost price, um, they have to focus on what are the ways in which the cost can be reduced. So if there is a greater focus on cost reduction, then the present marketing scenario is that they are more focused on customer. That is called as a relationship marketing. They are looking at building up a relationship with the customer, to know the customer, the buying pattern of the customer, what do they want, customization. See, the way in which businesses are ensuring that they come back again. So there are certain offers which are given. If you come back again and again, some rewards would be there, some points will be added. So they ensure that your phone number is registered with them. They keep sending any offers which are available. They want, now the focus is more on building a relationship with the customer, taking care of the requirements of the customers and catering according to that. So the focus is more on customer, a need for more flexible production systems, customization, flexible production systems, catering to or understanding the requirements of the customers, taking the requirements and customizing their products according to the requirements of the customers. Then more employee participation, feedback is collected from them, so that how can they improve their production activities. Then shorter product life cycles, and a greater emphasis on quality. These are the characteristics of modern environment. Under that, there are many concepts which are there, but in our syllabus, we have one is TQM, one is JIT, and the comparison of TQM with standard cost. What is TQM? TQM talks about um, the total quality management. Total quality management uh, emphasizes on continuously improving their production process. The production process is on a continuous basis. Every effort is made to improve the production process. The end objective of TQM, total quality management, is to ensure that there are no defective products which are produced. So defect free production is the objective. So with that intention, the production is taken up. So at every given point of time, they ensure that they make continuous improvements, continuously they keep improving at every given stage. If required, additional costs are incurred at every step, every stage, and ensure that the production which is produced is uh, qualitative or quality wise. That's the best thing, up to the point that there is absolutely no defective unit which is produced. So that is total quality management. It says that TQM is the continuous improvement in quality, productivity, and effectiveness through a management approach, focusing on both process and the product. Okay, that is what is the total quality management. So, if total quality management is compared with standard costing, so what differences do we see? Standard costing is deciding the standards, and when the actuals happen, the actuals are compared with the standards. If there are variances, measures are taken to look into why there is a variance, and analysis is taken up, and then if there is a possibility to take corrective measures, they are taken. But standard costing looks at after the implementation happens. See, standard costing is it's more focused on after whatever happens. But TQM is a continuous process, a continuous improvement which is carried on. Standard costing is not that. Once the first thing is the standards are decided, then after the implementation happens, So when the implementation happens, the actuals are observed. These actuals are uh, taken in for comparison with the standards. So that is how it happens. But TQM doesn't go about that way. It puts an effort on a continuous basis, continuously keeps updating, continuously um, puts in every effort to improve their performance. Wherever there is a possibility to cut down their cost, they cut down on their cost. Enhancing the quality is enhanced. Every possible measure is taken. So focus is on continuous improvement. Then expects everyone to take responsibility for failure. So there is accountability also taken into consideration under TQM. Yes, this is also the corrective measures are taken. Their performance is also evaluated under standard costing. Also, performance evaluation is there. There's nothing like that. But the feedback on a continuous basis is also collected from employees, from those who are implementing the plan. From them, the continuously there is a feedback collected. Inputs are collected, they are implemented. So they expect everyone to take the responsibility for the failure. They TQM does not accept waste as being acceptable. So end objective is no defective unit should be produced. So there is no excuse if a defective product is produced. What if the defective product is produced? Then that has to be reworked on to make it as usable. So additional rework costs have to be incurred if there is a defective unit which is produced. So here it says that there should be no waste if rework costs have to be incurred, that is a wastage in cost. So it does not accept waste as being acceptable. Then it's more concerned with quality related costs than production costs. There are four different types of quality related costs. At the time of implementing, even before that, that's called as prevention cost. At the time of implementing, before that only certain measures are taken. That is, the designing of the machinery is fine, that so that there's no defective units produced. Then the training is provided to the employees so that they carry on with the activities in a perfect manner. Then after prevention costs or preventive costs, then they when the production process is carried on, at that time also through when the production work is carried on also, randomly they pick out and check whether there is any whether the units produced are perfect. So the process itself they verify. So for that they require some inspection cost, quality checkup costs and all. So they are called as appraisal cost. After the production is finished, then randomly select any finished unit and then check for the quality. If it is not up to the mark, then costs are incurred to rework on that. So that is called as internal failure cost. So there is a failure because the unit produced is a defective one. So they have to rework that. But the only solace is the unit was not delivered to the final customer. So internal failure cost, let's say the unit produced is defective, it skipped from their inspections and all, the unit was also delivered to the customer. If the unit was delivered to the customer based on the warranty guarantee terms and conditions, they will have to provide some services to the customers. So we see that those costs as external failure costs, because it's a failure, it's delivered to the customer, but now they to make it up, the business has to provide certain um, service costs, the warranty guarantee and then after sales service costs have to be incurred. So they are more focused on quality related costs. Their focus is not about the production cost. Production is all taken over by the technology. Okay, continuously they ensured about that. But here the focus is more towards the quality, how the production is taken. Anyway, that is accounted for, but more than the production, then their focus is on the quality related. Standard cost doesn't look at the quality related aspect. The focus is on what is the standard cost of production, what's the actual cost of production, compare the standard cost and the actual cost. If there are deviations, variances, they are analyzed, what are the reasons, and then appropriately the measures are taken up. then usually incorporates JIT inventory control so that material variances are less likely. But what is JIT? JIT is a concept. JIT is a concept about how the inventory is acquired by the business. What is this concept of just in time? The conventional method of purchasing inventory is, see, when there is a supplier, the business approaches the supplier, or rather business calls in from all the suppliers that uh, they submit their tenders or quotations. So that's the first step. The first step is the business uh, requests all the suppliers or ask all the suppliers to submit their tenders or quotations. So from among them, the best one is selected. After the supplier is selected, an order is placed with the supplier by the business. So there is an order which is placed. Catering to the order, the supplier supplies the material. The order is delivered. Let's say the order is delivered. So after the order is delivered, it is not directly moved into the production department. There is a procedure. The material is at the gate, factory gate. It is checked for quality. Randomly, something is picked out and then checked for the quality. They are assured about the quality aspect of it. That is moved to the stores department. Stores department, from there it is moved to the production department. From the production department, the finished products are moved to the either the warehouse, go downs, or showrooms directly. Then the material is kept available, the finished goods are kept available for the customer. The customer approaches the business, purchases the product from the showroom. Now all this is done before the customer approaches the showroom. So they not knowing whether the customer would come or not, there is a whole set of activities, a chain of activities, what we call it as supply chain. Starting from the supplier delivering the goods, then they are moved to the stores department. In the stores department, the material is stored. From the stores department, it is moved to the production department, and the production is carried out. Um, After the production is carried out, it is moved to the go down. From the go down, it is moved to the go down or warehouse or whatever we call it as. Then it is moved to the showrooms, the stores, and the customer approaches here for the product. So the day when he approaches, he takes the finished good. But before the finished good are purchased by the customers, a whole set of activities are carried on. That is the conventional way. So now we see a sequence of activities that connect the supplier to the customer. So that's called a supply chain. See, when they are taking up all these things, this is all based on some forecasted demand. They are forecasting the demand to be present as on a future date. In future, the customers would come with the requirements. So to cater to the requirements of the customers, all these activities are taken up. This is not instantly done. It is a time taking process. So selecting the supplier, receiving the material from the supplier, placing in the stores department, from stores to production, from production process is also time taking process. Then moving on ultimately to the showroom, and then the customer purchase. So throughout this period, the funds which are invested in inventory are blocked. The material, it is blocked. They do not get any cash until the customer purchases the material. So during this period, all their funds are blocked. On these funds, they have to pay cost of capital, they have to pay interest cost or whatever is that they have to pay that amount on the funds. Plus, to store this material in the stores department, production stores department, stores, wherever, they have to incur storage costs. So the conventional method basically has costs which are incurred. It's a cost incurring procedure. So to eliminate these costs, not investing anything in inventory, but waiting until a time when the customer approaches with the order. So JIT system talks about, so wait until the customer comes with an order. So when a customer approaches the business with an order is placed. So to cater to the order, the business should be ready with the finished product. But then there is no production which is taken up. So instantly, just at that time, production is taken up. So they start producing. But to produce that, there is no material. So when the production has to be taken up, there is a requisition for purchase of material. Production will depend on the purchase department for the material to be purchased. So the purchase department now will approach the supplier. It's the same sequence of activities, but in the reverse order. Initial, the conventional method is starting with the supplier and ending with the customer. But here in JIT system, it starts with the customer. Customer, when the customer comes with an order, to cater to that order, production is taken up. Production to take place, material is purchased. Material is purchased from the, I'm really sorry, I wrote this customer, it should be supplier. Then to purchase the material, they approach the supplier. Done. But can it be done instantly? Can it be done just in time? So there is a method in which things can be done just in time. The supplier, first thing, there is a procedure that orders are placed with the tenders are called from the suppliers, selecting the supplier, placing an order, receiving the material, checking the quality. All that is a time-taking process. So what they do, they beforehand only select the supplier, decide on the terms and conditions, the quality, the price, everything is decided. So whenever they require material, they place an order with the supplier. Supplier instantly supplies the material, and the supplier happens to be a reliable one. They select a reliable supplier who does not fail to supply the material. So whenever they require, instantly it can be received from the supplier because all the terms and conditions are pre-decided. Then production process is also time taking process. Many different types of workers, many skills are used in production. So what is done is the manufacturing place is considered to be as a work cell. In that work cell, all workers understand all types of work, to run the machines, to operate the machines, to replace any worker. All this work is taken up by every worker who's present in the production place. So, without any delay, without any break in the work, the work is completed and it is delivered to the customer. So, very quickly they take up the work, finish the production, deliver to the customer, and receive the amount from the customer. In this process, storing of that material is not needed anywhere, so storage costs are not incurred. Since they are not investing anything in inventory for a longer period of time, instantly everything is settled, so cost of capital also can be eliminated. So that is just in time manufacturing. So what is the main focus here? Cost control is the focus, just in time. So they ensure that everything takes place right at the time. They don't have to store anything for which storage costs are incurred, no storage cost required, no cost of capital required. Okay, so the conventional method is called as, it's a push system. They are pushing to the next level. They're pushing to the next level even without knowing that the customer ultimately will come back. Of course, there are certain estimations, certain forecasts based on which they estimate the demand, and then accordingly they take up. But even without knowing the for sure that there would be demand from the customer, material is moved to the next level, pushed to the next level. So it's called as push system. But JIT is a pull system. They don't have anything, but they pull the material from the previous levels. So they keep pulling customer to supply to the customer. From the production, they try to pull. There's no production. Production pulls the material from the purchase department, no purchases. The purchase department approaches suppliers and instantly gets the material. So that's called as a pull system. Okay. Goods are only produced when they are needed. This eliminates large inventories of materials and finished goods. This is a part of TQM. TQM talks about cost reduction. TQM talks about quality aspect of it. So those things are taken into consideration. So that is about the modern manufacturing environment. So we end this topic here. Um, you will be learning JIT, you will be learning TQM, you will be learning about a part of variance analysis, even in APM. So these topics will again repeat in APM. Right? The next part of it in the syllabus, tomorrow we'll take it up, is performance measurement and control. So um, all what you have learned in management accounting, the entire ratio analysis will be repeated. Apart from that, there are certain other topics also. Okay. So tomorrow's class will be the last class. We'll end the syllabus tomorrow. Okay. Is that clear?
Yes, ma'am.
Fine. Let's end the class here. It's already 11. Let's end the class here. Good day.